suffice to say, you are entrenched in the UHNI community on a lot of fairly new and different offerings than the normal equity offerings that are out there as well, right? So let me try and pick some brains on that front. Can I first start off with, at the current landscape, what has been your advice, or what has been the average millionaire client's response to what the portfolio allocation should be across the various investing options available?
Yeah. So, so interestingly, clients have matured over the course of the last few years, right? I was laughing that during COVID, especially over the last 12, 18 months, I mean, let's count out the last 6, 7 months, which has been turmoil, etc. But before that, the only thing that didn't turn to gold in the market was gold, because everything else that you touched, whether you touched fixed income, whether you touched equity, whether you touched private equity, whether you touched venture capital, right? Everything was booming. And then there was a large dose of reality that happened over the course of the last 6 or 7 months, where for a combination of factors, be it macroeconomics, be it Russia, Ukraine, be it earnings, be it the general change in sentiment. I mean, we can talk about it till the time the cows come home, but it's a very different investing market today. And what I'm very surprised with this time, as compared to 2008, as compared to 2010, 12, etc., is the maturity that I've seen with regard to clients, right? The millionaire clients typically are doing, for want of a better word, are doing two things. One is that they are being very thoughtful with regard to their portfolio asset allocation, right? So you'd seen a little bit of FOMO happen over the course of the last 1 year, and therefore you'd seen a little bit of imbalance in client portfolios, everywhere, because there is always a little bit of an element of greed and, whatever. But this time you didn't see people go in one extreme, right? So to give you a sense, the trend in the last 1 year was that a lot of people had been loading up on direct deals in the private market space. People had loaded up on equity because it was going up. People had booked profits, etc., right? People were loading up on private debt, right? And therefore, typically that risk curve had moved because people were very optimistic about what was happening in India. I think what has happened over the last 5 or 6 months is that reality has caught up. So there are 3 or 4 things. One is that I'm a huge India bull going ahead for the next 5 years. And I believe that today is a great opportunity to basically look at 2 things. One is valuations are becoming a little bit more reasonable, right? The pain is still not out completely. I still believe that this pain will continue for the next 6 to 7 months, but I think there's some level of realism and reality coming to public markets. I think there's a great trading opportunity that's emerged in good quality fixed income, because now you're seeing AAA at a much higher spread than what you saw historically. And I think the third thing that has happened is that there is a dose of realism that's come in private markets, where from it being a seller's market, it is slowly shifting towards looking at operational excellence, looking at large quality names, looking at it being a buyer's market. And interestingly, clients are perceiving that to be the same. So clients are this time not worried. They are not reacting adversely. People are looking very seriously at portfolio allocation. People are also looking at seeing, are there mispriced opportunities that are emerging, and therefore can we go in, right? So this time I've seen a much more measured approach, both with regard to people deploying cash, both with regard to people keeping some money at the sidelines, right? As well as how they're getting back into opportunities.